Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blikre, your host, and back with me is the voice of the people, Sydney Freed, who's here to ask the people's questions and keep things simple for you, the viewers. Today, we're going to be talking about the outlook for stocks, given the influence of Jay Powell and the Fed, President Trump and his team, company earnings, and even generational spending patterns. We've got the baby boomers. They are in spend mode. And today we're going to do all of that through the lens of the retail trader, which happens to be our phrase of the day. And this episode is brought to you by the number 6.58%. That is the 30-year mortgage rate reported by Freddie Mac, why this key rate in the housing market will not necessarily be going down just because the Fed is lowering rates. And today we are welcoming Stephanie Guild. She is a Chief Investment Officer at Robinhood. She's a CFA charter holder, that's Chartered Financial Analyst, and a 2-decade JP Morgan veteran. She also leads Robinhood's market outlook and research for retail investors. It is great to have you here, Steph.
Thank you for having me.
Well, thank you. And let's just start with your current market outlook. And you have a kind of unique position given your position at Robinhood. What do you see in the markets right now?
I think the markets obviously have recovered a lot since their dip in April. And so you've seen, my view is I haven't changed my general target on the S&P. I'd set it at the start of the year and I adjusted it down a bit when Liberation Day happened. But I kind of think it might still be right. They always say your first answer is the correct one. Yes. 6,500 was my target and we're kind of around there. Yes. So, which is making me a little bit nervous just in the near term. I do think we're in a seasonably unfavorable period because I do think we get to this point in September where a lot of companies have to go in their quiet period. We've had all the earnings we can have for a time period. There's not a ton of economic data that comes out. The Fed eventually goes into their time period, quiet period before rates, before the next meeting. Yeah. And then I think the market gets left on red, so to speak. And so I think we get to this period where it can be quiet and the market is left wondering really what's happening, and there's still a lot of questions out there. So that's in the near term a little nervous, but I don't think there's a ton of reasons to be worried yet because I do think Powell said on Friday, the risks are balanced right now.
Yeah, and we got a huge market reaction to the upside on Friday after that. We'll circle back to the Fed in the second half here, but I now want to get to our phrase of the day, which is retail trader. A retail trader is an individual who invests and trades their own money. And we should contrast this with the institutional trader or investor who generally manages larger amounts of money for others. And so how do you view the retail trader? And I mean, I got to think back to 2021. I'm not going to draw any huge parallels to then versus now, but Robinhood was kind of meme central and caught up in that 2021 GameStop AMC frenzy. How do you see retail traders now?
One, I don't like calling them retail traders because I think it can have a sort of condescending connotation. I think that was the name what institutional traders gave, an everyday investor. And I think the world has really changed from an information perspective. There's access to a lot more data for everybody. And Robinhood has been at the center of that. Obviously, we were the place that people, start making their investments and hopefully continue to grow their investments as we've seen. And I think that they're getting smarter and smarter. Our customers are very savvy, and we see them doing things that I have seen in my experience very senior portfolio managers do, which is buy core positions that they believe in for the long term and trade around them and the volatility that they have.
Do you know how they're getting their information? First of all, I don't like retail trader either. When I first heard that, I equated it with a day trader, someone who's actively in there. I was like, if you just buy some ETFs, are you a retail trader? That feels
technically
we can argue about that. But how do you think these everyday traders are making their decisions? Do you have insight into that?
Yeah, I think there's almost three kinds. One is the active trader that is trading every day, and they may have very short-term positions put on either through options or through single names. And I think that is a very technical-oriented type of investor, and they're looking at the charts. And so we have, Legend we have a whole toolkit for our customers like that. Then I think there's like the long-term investors, right? Then they may buy a mix of single stocks and ETFs, and kind of, when things go down, they may add to it, or just have a consistent approach to adding to their accounts. And we have something like recurring, where you can just like consistently invest in things over time with cash flow. Then I think there's something like in between that, which is where they're getting their information, and they may actually take 6-month, 12-month positions and around the volatility trim and add those. And I think where they're getting their information is a whole host of things. Like you can pay for access to certain types of things. I think we've also seen the explosion of information on social media. Like there are influencers who do have honest takes that are, I think, sometimes almost as good as the institutional research.
I love how you kind of open up this discussion talking about the Robinhood traders or investors establishing a core position, trading around it, and that's really more how the institutionals trade and invest. And just kind of you spent 20 years at JP Morgan, you were a portfolio manager. Can you walk us through how you were managing money back in the day and how that might relate to an investor who's just trading their own account or investing their own account?
Yeah, so I think you definitely do a lot of reading and understanding like where are trends, what's your time horizon? You always want to know that, and how much risk are you willing to take? Like I think for the everyday investor, you want to make sure, and this is the most boring thing, but you want to make sure you have like cash sitting on the sidelines. That's like in case something changes in your life you didn't expect. Like,
sure.
You lose your job, you have an expense that you didn't expect. Like, you want to have that. And I always say it should be around 6 to 12 months, but that can vary again from person to person. Once you have that, I think you want to have some, maybe some diversified exposure, like have some foundation of broad-based ETFs. And then once you have enough of that, and all this is personal to you, I think that's where you can start. You need to take some risk. I always say, like, I think there is a world where you can be over-diversified, and you want to have some bets, right? Where is the world going? Like we see our customers, because they're younger on average, investing in quantum computing. Like we don't know where that's going to end up, right? Obviously AI is a big piece of it. And then you have some of the well-known brands. When I was investing, I took a lot of things into account where I think long-term earnings will be. And I think expectations are really important to understand. Like I've always thought about that. If for example, data centers and power generation are a big theme now and probably further into the future, because
utility is kind of the complementary AI trade.
Yes, exactly. Because it's going to gobble up all of the power that we everyday people need to just have our lives. And so where is that going to come from? But how much of that is already in the price, right? Like what are earnings expectations, and do I think that they can continue to, meet or beat that rising bar? And meeting is not even enough in this market anymore.
I was just going to say, because I feel like when you're investing for yourself, something like data centers now, it's in the news a lot. Like that's a good AI play.
Yeah.
How do you know when you're behind kind of the curve and you might not want to get in right now versus like, oh, I'm looking for like an under the radar play? I know that's like, if we all knew the easy answer to what's the underrated play, we would go there. But if you're investing for yourself, how do you think about like potentially being behind the ball?
I think it's one, you have to think about your own time horizon. But two, I think this is where a technical analysis can help. And what I mean by technical analysis is like looking at the charts and taking a broader view. And even like if you can plot it, whatever kind of thing that you use, if you're plot like 50-day moving average, a 200-day moving average, and then plot it against where the price is, right? And say, where has it been going? Has it had any dips? When it does dip, does it breach any of those barriers? And that can help you figure out like your timing. If it's up and to the right, like, look for some small opportunities and maybe make a small position, because I've also found that like you can watch something, but the way you really watch it is if you have some skin in the game. So make a small position and start riding it. And if it goes down, it's like, okay, maybe now is my time to add, or maybe something's changed in the thesis.
I love that you brought up technicals right now. That's kind of my bread.
I was literally going to interrupt.
You knew that was my next question.
Jared's bread and butter.
All right. But so you mentioned the simple moving averages, and that's a great place to start. You can also look at the slope. Are the moving averages themselves going up and down? Anything else? How would you suggest investors kind of dip their toes into technicals here? Because it's really easy to get overwhelmed.
Yeah, there's a guy we actually had. So we have an annual client conference now. This year will be our second one, and we had. This gentleman's name is John Roque. He works at 22V Research, and we had him come speak to our customers in a panel, and you can actually find it on our YouTube channel. He said of all the things, he was like, I've been doing technical analysis for a long time, and I agree with him in this, which is why I'm bringing him up, is that he says, he used to listen to this, I forget what he called it, but some guy who would look at like 120 different things. And he was like, you know what? Actually, I don't have the ability, I don't have the mind frame for that. And what he's found is that simplicity is better. And so I've taken a page from him and said, like, I really just look at the moving averages. Sometimes I look at RSI, which is a relative strength index, see whether things are moving up and down based, like you look at the volumes and the big moves. Those are just some, like, I don't think you need to do much more than that. He actually trademarked a metric. It's called
simple one, I hope.
It's called Brobdingnagian. It's hard to say, but what it means is like, is the chart setting a base and getting ready to break out? So if you see something moving kind of sideways for a long time, and then you kind of look at the company or the trend and say, is this building to something that's going to break out? That can be a kind of a cool symbol, but it can be in a base for a long time. So
I love all that. And just hold that thought, because we got to take a short break here. But coming up, we're going to be talking mortgage rates staying stubbornly high despite Fed rate cuts, plus a runway showdown classic, earnings versus multiples. Stay tuned. This episode is brought to you by the number 6.58%, and that is the current 30-year mortgage rate supplied by mortgage giant Freddie Mac. Over the last 2 years, it's been as high as nearly 8%, as low as almost 6%. But what we want to talk about right now is where it is going. And despite the fact that the Fed has been cutting short-term rates, we've been seeing longer-term rates heading higher. And this is not without precedent. We've seen it happen before. I don't think it's happened for a few decades. So we're not trying to say this time is different, but it's not intuitive. The Fed, we should reiterate, acts on the very short end of the market, but these longer term rates, because of various factors, and we can get into that, heading higher, how do you make sense of all this?
So historically, the Fed has cut going into or already in a recession, right? And they do it in almost every last cutting cycle. Except for this most recent one, right? Because they had raised rates to fight inflation, and so they had pulled it back because inflation looked like it was, has been moving down. So besides that, there had been it was hand in hand, recession and rate cutting to stimulate growth and get us out of a recession. And of course, when you have a recession, rates across the board go down, right? Because inflation expectations come down. That's another big piece in longer term rates. And the thing that does drive mortgage rates is the 10-year. And inflation expectations go into that. And the other thing that now I'd say more recently has become a thing is supply and demand of treasuries. And what I mean by that is
a lot of supply on deck here.
A lot of supply. The government has been borrowing an growing amount every single year. And obviously there are some other things in play right now that can slow down that train, but I don't know if it's going to fully stop it, which is the tariffs. Revenue collection can help offset some of that. But if we have a rising amount of supply and if you don't have a rising amount of demand, then those rates, right? Like if there's something in your store that is no one's buying, what do you do with it?
Well, you lower the price.
You lower the price.
And that's what bonds do. We get lower prices, and since yields move inversely, you get higher rates.
Yeah, exactly.
So do you think there's a chance that the Fed is behind potentially in its cut, or do you see a recession? Since you said previously cutting and a recession go hand in hand, is that not the case this time?
Not the case this time, I don't think. I don't see major signs of a recession yet, But I do think that the Fed had been solely focused on inflation. And I kind of understand it. I actually wrote about this recently in my Investors Guild, which is that if anything that big that happens in your life, you always sort of think about that and say, I never want that to happen to me again.
Sure.
And inflation got out of control.
It becomes an obsession.
Right. And inflation got out of control for the first time in decades. I mean, real decades. Not since 1980 or whatever. So I think they were thinking, we cannot let that happen again. The inflation shock was real for everybody. And so they were very focused on that. Inflation has been stubborn at that like kind of 3%, 2.8% mark. And they wanted it at 2%. They just really stuck to that. But what I worry about in this environment of they keep saying, well, with tariffs, we don't know what that's going to do to inflation. We also, and they finally just admit on Friday, we don't know what that's going to do to the labor market. If a company doesn't pass on higher costs in the form of inflation, they will look to keep their margins the same and cut costs. And sometimes that can mean in the labor market. So if we do have that, then you could end up trending toward a kind of softness / maybe recession. I don't like to say the word too many times, but
you get 3 in this show.
Get 3 and then it appears. So
but it's something that I think they've just decided to admit on Friday that like these are both risks, and now we have to think about both of them. But I don't think it's imminent. So I think 1 or 2 cuts are insurance cuts, like they did in 1994.
I want to ask you about something you wrote to us in your notes, and it's you got to watch what Trump is doing and what Treasury Secretary Bessent is saying. Break that down for us.
Yeah, I think I said WWP.
Yes, you gave some nice initials. We're going to put that on screen there. I didn't.
Yeah, so I just think that this. So kind of quickly going back on Powell, I used to call him the markets DJ because he would, he would play the song and the markets would react. I think the decks have been passed to the fiscal policy, and President Trump is quite clear. If you read through like his language, I think as an institutional investor historically, you might want to listen to it and read through the lines. And I don't think you need to do that. I think you hear, we're going to do this, we might do that. It often ends up happening. Or, you start to see like the investment with Intel, and it's not the only one, right? Like these are unprecedented moments in a way. There's been some related times, like in 2008 when, car companies were
we invested in them.
Right.
But I mean,
to save them.
Sovereign wealth fund in the U.S. is something that's new,
right,
to my understanding.
And this is investing not to save them. It's investing to, well, maybe Intel, but they're
Let's not get down on Intel.
No. But I think, and then Bessent goes on a lot of, newscasts and he says like, we're going to have this much in tariffs by this time. This is going to do this. Like, I think they're giving you the playbook and you have to listen to it as an investor.
Well, so as an investor, though, how do you listen and make decisions in your portfolio when there's kind of so much being thrown around?
Yeah, it's a good question. Like one example I think is, what they're like when NATO happened, right? And the NATO meeting happened, and there was a lot of talk about like we had a great meeting. We're gonna all make investments in aerospace and defense. Like I said, this is backing up my expectation that the entire government is going to be more technology is going to flow into the government, right? And there's going to be more spending in non-traditional types of aerospace and defense, and that's not just going to be by the European countries, but also by us.
We got to pivot here because I do want to get to today's runway showdown where we are stacking up the earnings engine versus multiple magic. In other words, which matters more, the actual profits and losses a company reports each quarter or the valuation multiple that investors they slap on top of that? So on stage left, we've got the earnings engine, revenue growth, margins holding firm, EPS revisions pushing higher, and free cash flow in gear. And on stage right, we've got the multiple magic. Prices rising as valuations or that multiple stretch. It might be thanks to Fed rate cut hopes, fiscal policy vibes, or just liquidity itself. Money on the sidelines money on the sidelines looking for a home. So the question to you, Steph, is who's wearing the next leg of this market best today? The companies earning it or the multiples making it look easy?
I think earnings have definitely been winning out this year. But the market, I think, at this past earnings season, I do think you saw a little bit of a shift in that the ones with very high multiples had much more scrutiny on them. And they had to beat in every single category that, not just earnings, but guidance. I mean, guidance is almost even more important than looking in the rearview mirror of what earnings was. And so I think you're starting to see a shift. Valuations do matter. I think there's certainly a lot of people out there that are saying they don't matter anymore, and I don't.
They always say that when it's sky high.
I've seen this movie before, and they matter, but maybe not in the ways that they used to, because used to have interest rates be also like a part of that valuation story. And now that interest rates may be a little bit more sticky as to where they are, I think valuations relative to earnings matter more in the long term.
I'm curious, Steph, so your S&P target you said was 6,500 earlier, correct? And we're near there now. So I'm curious what investment ideas you have for this back half of the year if we're not going to go too far higher according to your target.
Yeah, I think because I do think like another theory or view that I have is the Mag 7 is no longer the Mag 7. You need to analyze those 7, large tech companies individually as if they're on their own, rather than being this conglomerate that you necessarily invest in. And because they dominate so much, right? Like the top 10 names are such a big part of the S&P. Those have very high valuations. The bar is very high for them, that I think the opportunities are below that, which means that it makes it harder for the S&P to go a lot higher. Like it will be a grind, whereas the opportunities do exist on some of the, I think, less expensive areas of the market. So that might be regional banks, especially if like M&A and deregulation start to come out, and we do have a steeper curve, meaning that short-term rates come down a little bit, but long-term rates kind of stay around where they are. I think some of the cheaper tech names, like in the software space, they've been not as strong this year. Some continue to be a little weaker, but I think there are some diamonds in the rough there. And I mentioned, aerospace and defense already. Those are kind of some of the themes. But in the very near term, because I'm a little worried about, I do have a little bit of T-bill exposure in our, we have some managed
cash,
assets.
All right. Cash still not necessarily king, but still in there.
Just for dry powder, if we have some softness in September.
All right. And guess what? We got to leave it right there. That has been a show. And just to recap a little bit, I love that our phrase of the day, retail investors, retail traders, really not the best way to characterize them, maybe. But hey, we gotta confront these issues head on here. And I really appreciate your time, and also kind of elucidating the fact that retail investors, or whatever you would like to call them, are really getting a lot more sophisticated. The playbook is approaching, if not that, of the institutionals as well. And we're gonna have to leave it there. So we will see you next time on Stocks in Translation.